In the age of algorithmic trading, are your safe bonds secretly being manipulated by AI? High-frequency trading can amplify bond market volatility, turning even safe treasury bonds into risky bets. Learn how these hidden forces shape bond prices, and discover if your portfolio is prepared for the unexpected. So, are bonds still a safe investment? To understand this, let's first talk about what bonds are. Think of a bond as a loan you give to a government or a company. They promise to pay you back with interest over a set period. Traditionally, bonds have been seen as a safer investment compared to stocks. But is that still true today? One thing that affects bond safety is interest rates. When interest rates go up, the value of existing bonds can go down. This is because new bonds will be issued with higher interest payments, making older bonds less attractive. So if you need to sell your bond before it matures, you might get less money than you paid for it. Another thing to think about is inflation. Inflation is when prices for goods and services rise over time. If inflation is higher than the interest your bond pays, you're actually losing purchasing power. Your investment isn't keeping up with the rising costs of things you buy. Also, there's credit risk. Also, there's credit risk. Also, there's credit risk. Also, there's credit risk. This is the risk that the government or company that issued the bond might not be able to pay you back. Credit rating agencies like Moody's and Standard & Poor's assess the creditworthiness of bond issuers. Bonds with lower credit ratings are considered riskier, and they usually offer higher interest rates to compensate for that risk. These are often called junk bonds or high-yield bonds. The current economic situation also plays a big role. Right now, we're seeing rising interest rates and inflation. This means that bond investors need to be extra careful. The Federal Reserve, which controls monetary policy, is raising the federal funds rate to combat inflation. This can further impact bond prices. There are different types of bonds, each with its own level of risk. Treasury bonds issued by the U.S. government are generally considered very safe. Corporate bonds issued by companies carry more risk than government bonds. Municipal bonds issued by state and local governments can be tax-exempt, making them attractive to some investors. Bonds can still play an important role in a diversified investment portfolio. They can provide stability and income, especially during times of stock market volatility. However, it's important to understand the risks involved and to choose bonds that match your risk tolerance and investment goals. For Maria, nearing retirement, focusing on high-grade bonds might be suitable for capital preservation. For David, saving for education, a mix of bonds and other assets might be appropriate. For Mr. Sharma, income generation is key, so carefully selected bonds with decent yields could be beneficial. So, are bonds still a safe investment? The answer is complex. Safe is relative. While bonds offer some protection compared to riskier assets, they are not without risk. Factors like interest rates, inflation, and credit risk can all impact their performance. Whether they are suitable for you depends on your individual circumstances and investment strategy. The yield curve, quantitative tightening, geopolitical events, and even supply chain disruptions are some things that can influence whether bonds are safe. There are many other complexities regarding bonds, such as duration, bond valuation, derivatives, and more. We didn't even discuss bond ETFs or bond mutual funds. To learn about this and many other important factors relating to bonds, please like, share, and subscribe to keep watching amazing videos.